Thank you for joining this presentation on the topic of SR 11-7, which is actually the subject of managing model risk. SR 11-7 is a guidance directive issued by the Federal Reserve Bank and the Office of the Comptroller of the Currency in April of 2011. It addresses the management of risk associated with models that may be used by banks in a variety of decision-making roles. It was noted by bank regulators that for many years, banks had increased the use of models in their business and functional activities. If a model was incorrect, poorly constructed, or misused, it could result in the bank experiencing a variety of risk consequences. A model is defined by SR 11-7 as any model that constitutes a methodology, a system, or an approach that is quantitative in nature and utilizes any theories, techniques, or assumptions to generate quantitative assessments that may have a statistical base, an economic base, a financial base, or a mathematical base. A model may be used for a variety of business and functional purposes. Some of the more significant uses of models are to analyze a business strategy, support business decision-making, to identify and measure risks that are present in the bank, to value the exposures within a bank, to stress test market exposures within a bank, to assist in the bank's capital management, and to manage the bank's internal guidelines, limits, and regulatory requirements. There are many types of models used by banks, and I would like to highlight some of the more prominent types of models that are used. First is a market risk management model. Value at risk model, commonly referred to as a VAR model, is the most prominent market risk model. Its purpose is to identify and measure the financial risk of one or more asset holdings for a defined time horizon by applying different economic and market assumptions to establish the potential level and probability of financial loss for the defined time horizon. A VAR model represents the percentage probability of defined dollar loss for a defined time horizon. I would note that in addition to establishing the degree of probable risk an institution has for that time horizon, it is also useful for an institution's management to see if the institution's level of risk is increasing, decreasing, or staying the same. Another type of model usage is in the area of managing credit risk. There are many credit risk management models used in the management of a bank's loan portfolio. Some of the more common models used are to identify the potential of default loss over defined time horizons, to forecast and establish a bank's level of loan loss reserves, to identify changes in the average credit rating of a bank's portfolio, and lastly, to establish a level of counterparty risk created by specific types of asset trading. The third use of models is for the management of a bank's capital. A capital management model is used to calculate the absolute level of a bank's capital, as well as to calculate its capital positions relative to FRB guidelines, as well as internal management targets. Models are used to forecast a bank's capital relative to its capital requirements over defined time horizons. This forecasting will consider maturing capital, planned capital creation, changes in the level of assets, changes in the types of assets and their impact on requirements, given that certain types of assets have different capital requirements, changes in earnings and the retention of earnings, and planned capital distributions. Fairly recently, there have been new regulator evaluations referred to as SAR and CAMELS. SAR stands for Comprehensive Capital Analysis and Review, and CAMELS stands for the 6 areas of its evaluation, which is capital, assets, management, earnings, liquidity, and sensitivity to market risk. Another use of models is to manage a bank's liquidity. Liquidity models are used to establish a bank's absolute level of liquidity, as well as forecast the bank's liquidity requirements over defined time horizons. This liquidity assessment considers potential changes in the maturities of a bank's assets and liabilities, potential changes in the maturity relationship of its assets and liabilities, potential changes in its sources of funds, potential changes in its interest maturity gap, which is the interest rate relationship of its assets and liabilities in terms of their maturities, and potential changes in its liquidity assets. In addition to the institutional CAMELS evaluation, which also addresses liquidity, there's another evaluation methodology which the regulators have adopted, which is CLAR, which stands for Comprehensive Liquidity Assessment and Review. Should note that CAMELS, CSR, and CLAR are used for rating a bank's management of these number of different areas of management requirements. Models are also very important to the area of investment portfolio management. Investment portfolio management models are used to forecast the performance risk of a portfolio over defined time horizons. This forecast can address the portfolio's absolute level of risk as well as relative return risk when there is a return benchmark. The factors used by a portfolio management model would consider a portfolio's asset class allocations, the primary ones of which would be cash, fixed income, equities, commodities, and currencies. Next, it would look at or consider the allocations within each asset class. In the case of a portfolio's fixed income component, it would consider its maturity structure and asset quality. In the case of a portfolio's income and equity components, it would also consider the country exposures that would be in the portfolio. Other considerations or factors in an investment portfolio's performance model would consider the presence of currency exposures, both in terms of the total amount of such exposures and the amount per currency. And lastly, it would consider the presence of leverage in terms of the total amount of leverage employed, as well as the nature of the leverage. Another and very important type of model is a stress testing model. Stress testing models can be and are used in a variety of business and functional activities to evaluate the impact of changes in the structure and price level of exposures over defined time horizons. Some of the common areas of stress testing are used for an asset portfolio, a bank's asset and liability interest maturity structure, an investment portfolio, and structured investment products. And lastly, in the area of financial management, models are used to evaluate the forward-looking financial condition and financial performance of a bank based on different economic and market scenarios that may impact the bank. This evaluation will consider a bank's current asset and liability makeup, as well as changes in its asset and liability makeup. It should be noted that fairly recently the Dodd-Frank Act has imposed on banks more rigorous stress testing requirements to address the bank's ability to remain financially viable under adverse economic and financial market conditions.